Get my lower third.
Hi, and welcome to another ISOOSI Chat, our regular Tuesday roundtable discussion about search, social, and all things marketing. And today we're going to be talking about the big F word. That's finance and everything in relation to business and finance. And today we've got a very special guest. We've got Stephanie Sims from Venture Advisors. She's a financial advisor there. And we also have Ammon, ISOOSI's search marketing consultant and resident ISOOSI Chat expert on all things search. We have Bill Slawski, Director of Search Marketing at Goldfish Digital, and Eric Stafford, Creative Director at ISOOSI. What an amazing panel. And Ammon's got his Union Jack there, obviously for the World Cup maybe. But Stephanie, do you want to kick off and give a little bit of an introduction about Venture Advisors, or what you do, and just a little bit of an introduction?
Sure. First off, I'd like to tell you guys thanks so much for having me on, and thanks for taking on such a scary, sort of, topic, not being afraid of the F word. I think that's really admirable, because I know it doesn't happen all the time. My company, Venture Advisors, is a consulting company for small businesses, but what I'm really excited about working on now is a new method for valuing businesses that I call financeability, and that's what you can see on the lower third there. Basically, what financeability is designed to do is to help business owners understand and take control of their ability to get financing in their small business. We're going to talk about a lot of this stuff tonight, so I don't want to spill any secrets, but it's at the same time harder than you think, but easier than you think.
Cool. How long have you been doing that as a kind of a role? I know that you used to be an investment banker.
Yeah, I was. Yeah, well, my story is a little weird. I was in investment banking for about 6 years. Then I worked in a semiconductor manufacturing company that sold to the automotive industry, so more complicated production process and selling processes you probably can't find. I did that for about 10 years until we sold that company, which we were all really happy about. And that allowed us to move back to the U.S. in 2009, which is when we started Venture Advisors.
Cool. Well, don't get me talking about semiconductors, because that's what I used to do in a previous life. But yeah,
it's a fun business.
So there's definitely lots to talk about. I mean, we were just talking in the green room before about businesses that are trying to get, there's always different spots along the kind of the timeline. You've got startups that need cash. You've got small businesses that need investment to grow, and then you've got people looking for an exit strategy who need to kind of. But at all stages through that timeline, you need to know what your business is worth, what it's valued at. And I think that is the big thing that a lot of people can't get their hands around, is how to actually value what they've got, their business, if they have actually got an established business. Or, for example, people who are about to go and buy an established business, how do we get that valuation? I don't know if that's, that might be kind of a good starting point for this discussion.
Okay, yeah, we can start there. I think that one thing that's important to keep in mind when we talk about the value of a business is that there's really two pieces. There's two elements to the value, right? There's what's called the profit, which is how much money you're making every year, but then there's the, quote, value of the business, which is what most people have in their minds, which is what somebody's willing to purchase the business for in order to obtain that profit in the future. Okay, and so I think where a lot of people get confused is they say they don't see the link between those two pieces. Okay, so if we want to talk just for a minute about how your profit, which is how much money you make every year, is linked to the value, basically, if you put yourself in someone's shoes and you say, what would someone pay for this amount of profit every year, that's a good way to start thinking about the value of your business. That as a methodology is called discounted cash flow. It's got a lot of other names, but basically that's what it's called. And essentially the way that you calculate a value based on the future profits of a business is first you have to have a good idea of what those profits will be, which means you need to have, I'm going to use the B word now, a budget. Oh, disaster, tragedy. I know that scares a lot of people, but you do actually have to have a projection of what your profit's going to be into the future. And then you use a required rate of return, which means how much money would the person who buys your business want to earn. Okay, just like when you go to the bank and you put a deposit into the bank and the bank gives you, say, 1%. You're not going to leave your money in the bank for free, right? It's the same thing when someone invests in your business. And so they're going to have in their minds an idea of how much they want to earn on the amount they're going to pay for their business, for your business. And so what you're going to do is you're going to say, here's how much you're going to get each year. How much do you want to earn? And you divide all those cash flows by the amount they want to earn with a little bit of math going on, and that's going to give you the value today. Okay?
So for the layman on the call, people like me that maybe aren't much for numbers, can you explain what a budget is? No, I'm just kidding. I'm totally kidding.
Don't laugh. I've had people ask me that.
You know, the question I had, and I guess for me the easiest way to understand this is to just kind of create a fictitious business in my mind. So I'm thinking, let's say that everyone on the panel, and let's say everyone listening in on the Hangout today, owns an internet business. And it may be that you're a consultant, you're a webmaster, you provide SEO services, or you're even a small business owner and you sell digitally. Maybe you have an e-commerce cart, right? Let's say that your business is doing $100,000 a year.
Mm-hmm.
Right? And so to extrapolate that number out, and Carlos, I know you've got some experience with this because you've sold some digital businesses. How do you start to go about doing the math? If you're making $100,000 a year, part of it depends not only on what the business is bringing in, but also on what percentage of that is profit, and then you extrapolate out over several years?
There's one part to this we haven't mentioned as well, which is that the type of business makes a huge difference. This is a service business, and so predicting what its future earnings are when staff can leave, your own staff can open up rival businesses. A service business is the least valuable of all businesses because you don't own anything. You're predicting profit, but you don't own anything. Steph.
Right.
Well, you could own something. You could own some intellectual
technology, some patents.
But this is it. That's moving up the chain.
Information, a set of processes that we follow.
Yeah,
Right.
from my experience, you're not going to get paid on that client base, that processes, or things you've been put down, or future sales. I mean, there's value there. You may have built a brand up, but it's hard. Again, this is just in my past experience. People want to see revenue, profit, and then it's going to be a multiple base, a multiple on that profit based on the type of business. If it's an e-business, you might get, I've got 3 or 4 times profit in the past, or even 6 times profit. It all depends on, what somebody's really willing to pay based on, where things are going in, online, and what people perceive as its potential.
Right, and I think that's a good point that you guys bring up about the difference between the actual revenues and profits that are generated from the business and the notion of assets. But your comment there, Carlos, I think is very important to keep in mind. People are going to buy based on the cash flow or the profits that they can obtain out of the business. What they'll look at the assets for is more if everything goes south. If the sales fall off the face of the earth, what have I got that's going to keep me from losing my shirt? And that's what they'll look at the assets for. Yeah. So if you have, for example, as Bill mentioned, some processes or some proprietary know-how, maybe a patent, that can be a security blanket, if you will, but that's not necessarily going to drive the value of your business, particularly in the types of business that we're talking about. Okay? So to get back to Eric's question, I think that one of the ways we want to look at our budget, the way we're going to build what's called a projection, which is just a budget over multiple years, is to really focus on how we get those sales. So it's going to be important for us not only to know that we're making $100,000 a year, it's going to be important for us to know, for example, that represents how many customers or projects or individual units sold. Okay? So we really need to get a good handle on where those revenues are coming from, because that's going to tell us, okay, you're going to look at your business and you're going to say, okay, I know that, for example, it's going to be easier for me to sell a new product to the same client than it would be for me to go out and get a new client. And that's going to be in function of your business. Okay, but you have to understand where your starting point is to be able to say what's going to grow is either revenues per client or per project or my number of clients. Now you can also have both growing. It's not that any of this is mutually exclusive, but you got to know where you're starting. Okay, and especially if you're in the case where you've been in business for several years, it's really interesting to see how your business has already grown. You know, is what's happened that you've gotten more customers, or is it what's happened that you've given additional products or services to the customers you have? Okay, so that's a good predictor of what's going to happen in the future. The reason that you want to look at your revenues that way is because that's also going to drive your expenses. For example, in certain businesses, customer acquisition, getting a new customer, is a lot more expensive than creating a new product to sell to the customers you've already got. Okay? Does that make sense?
Yeah.
Okay.
Yeah, I think it does. In your experience, Stephanie, do you find most of the transactions in this space happening in terms of people buying equity in businesses and or selling equity or an entire business, like as an exit strategy? Or do you also see a lot of instances where, you know, people have viable businesses that are profitable, but they're just having sort of cash crunch issues in terms of money in, money out?
Well, it's a mixed bag, right? Because I think that there are people for whom owning their own business is really a lifestyle, right? That's what they want to do until they stop, quote, stop. Nobody ever stops working, but, you know, until they're ready to, quote, retire, they just want to keep this one business. In that case, what they're looking for is they're looking for financing to move to the next level. You know, they want to find enough capital to grow. That honestly is not a good space unless you're looking for a significant amount of money. That's not a good space to go looking for venture capital money. You know, that's not probably a good fit either for what you want to do with your business or for how you're going to be able to get the financing. A venture capitalist is on a very short time frame, and so they're not looking for somebody who wants to own their business for the next 15 years. That's just not their deal. They want someone who's going to build the business up in 3 or 4 years and turn around and sell it for, you know, 10 times the investment that was put in, because that's their model.
Lee Light has raised a very interesting question that addresses, you know, what we were talking about valuation. That a lot of today's most valuable companies, or the ones that seem to be, that sell for billions, have made no profits whatsoever.
Well, they have an audience.
What's that?
I said they have an audience.
Right.
I said WhatsApp.
Right, exactly. WhatsApp, for example.
But he said WhatsApp.
Yeah. Now let's be clear as well. We're not in the same space, right? I mean, you know, if we're talking about small and medium businesses, we're certainly not talking about someone who's likely to get purchased by Google. So there's also a difference in the type of person who's going to buy your business. If you are in a market that could attract Google, which is exactly what happened to WhatsApp, and you have a following, as Carlos points out, then there can be some speculative purchasing of your business. That's probably not going to happen for small to medium-sized businesses. First off, because you're not in a revolutionary type market. You know, now if you are, go after Google as a purchaser, definitely. But you know, it's in function of your market, but it's also a function of the people who are actually trying to invest in that space. Google, for example, wasn't looking for a return on investment when they bought WhatsApp. At least not with the purchase itself. That was not their goal. Their goal was to add eyeballs, really, was to reach an entirely new market. And so when they did that purchase, now, do they need to justify it? Sure. But my take on it is when they did that purchase, that was a marketing expense for them.
Yeah, of course, one of the things that Bill often draws interesting observations from is when Google buy things, they're usually buying it for the intellectual property rights, the patents that they own, or sometimes the deals they've already got with suppliers and other people. You're buying goodwill with another company sometimes rather than actually that company itself. So there's a lot of intangible assets.
Right. The one other thing that's interesting, Ammon, is that's also when you get to a level where that's the kind of investment money that you have, there's also the notion of buying out the competition, which does happen. In other words, you will actually consider purchasing a competitor not because it's a good deal to buy their business, but because it creates more security for your business and it consolidates your market position. So again, you need to look at who the purchaser is and what their motivation was. And in those cases, I think most of the time they're not looking at a strict ROI basis. That's not at all what they're going for.
So if you were looking to sell, say, an advertising agency, a digital agency, and that agency had a really outgoing, really attractive creative director, would that be considered an asset towards the sale that would add a lot of value to the company?
Let's think about this. Does this person?
You're a liability. You go in the liability column, Eric.
No, but here's the question.
We'll hire.
Does the person have a long-term contract?
It was more of a joke than anything, but if you think it's valuable information for the audience, then please continue. I was more joking. I thought it was really funny.
Well, no, I think it's a good point.
I
Carlos,
think it's a good
you need to
point.
get him to sign a contract for his soul so that the value of your company immediately goes up.
I guess, all joking aside, it probably is a really good point. I'm sure some businesses are invested in or even purchased outright based on the management team, right?
Right, but it's a very risky proposition. First off, because depending on where you are, in any case, you're not going to have somebody who has signed their soul over to the company, right? So even if they do have a contract, there's the potential that the person or team leaves, which will always increase the risk of the perceived risk of the transaction. So while having a great team in place is a reason to buy, it's again not going to be the principal factor of valuation. What it can be, in fact, in solopreneur or very small businesses, it can be a liability. And that's where, as a business owner, what you need to think about is, it's great that I do all this myself, but can I find somebody else and teach them how to do it? Because if I can't find somebody else and teach them how to do it, my business has no value the day I walk away. Because all that I know goes with me.
Yeah. It kind of goes back to what we said before. The main thing that what will be looked at is, profit, revenue. But then it's the way I look at it is staff or management team. It's not physical assets, but it's an asset to the company, and that type of thing will get looked on afterwards in terms of what's the turnover of that stuff. Have they all been at the company for 15 years? Have they been trained well? Have they got certifications, and have they been keeping up with thing, or is everybody leaving every month? That's when it can kind of go into the liability, or like a comfort blanket.
Investors are aware that they often want this exit strategy, and the minute you sell a company, a lot of people leave. So they always are aware of that, and this is one reason why the fact that you've got processes and you've got staff isn't worth an awful lot. It's much more important what intellectual property you've got, what contracts you've got, the actual things that transfer regardless of who buys and how much people don't like it.
Right. Well, and I think there's a balance there, and especially this is where it depends very heavily on the market that you're in. Again, as you get very small teams or solopreneurs, it's one of the biggest risks that are perceived in that market. This notion that, okay, if this person, they call it the bus theory, and I don't know if you guys have ever seen this explained, but essentially in valuing a company, they ask how many people have to get hit by a bus before the company goes under. And so the problem, obviously, with a solopreneur is the number's one. It's just you. And with a small team, it's the same kind of thing. One of the ways to combat that is to create, even if they're not full-time staff members, to create a sort of network of contractors and or colleagues, networkers, whatever you want to call it, who are able to assist you so that you can spread that risk out and say, look, I've got procedures in place. My social media is handled by an external firm, for example, or all my billing is done by my accountant. The more that you can show that there are other people who know what's happening within the business, the better you can really comfort people and say, look, it's not as risky as it seems. Now, it doesn't take away the whole risk. Don't get me wrong. People will always look for a higher multiple, not a higher multiple, a higher rate of return on a very small team than they want on a team of, say, 25. But it doesn't mean that you can't sell your business. It just means that you need to do your best to decrease that required rate of return by offering them alternatives to the risk they're seeing.
Yeah. I think most of our audience aren't too keen on selling, at least not at the moment, although, you know, come time to retire, they may well change their minds on that. You know, I'd love to hand my business on to my son, but is he going to be interested? Probably not. He wants to be a rocket scientist. SEO just doesn't seem very interesting to him.
How old is he?
He's 9.
Don't worry. When he gets to really complicated calculus, maybe he'll change his mind.
I'm hoping. But yeah, you know, why should they worry about the valuation if they're not intending to sell? Why is this still a very important thing to know?
The importance of valuation, there's really 2 reasons. One is because for yourself, especially if you're a solopreneur or you're in a very small business, your business is probably your biggest asset after your home. And it's probably the biggest asset that you own free and clear, since you probably can't get financing right now. So you want to make sure that you're growing that value over time, and you want to be able to identify how the value is growing. Not just did I get more cash in my pocket this month, but, you know, as I go through time, am I really building value here? So that's an important reason. But the second reason is that even if you don't want to sell, depending on the type of financing that you're trying to obtain, particularly if you're looking to obtain venture capital or angel investment, that's the basis for their investment, is your valuation today. And so the problem is, if you go into that process and you've got no clue what your company's worth, you're going to have no way to negotiate the best deal for you because you don't even understand what they're talking about, right? So while you don't have to become an expert and update your company valuation every month, it's important to understand the basic concepts and to have an idea in your head of what your company's worth, so that when you have those conversations as you're ready to get angel or VC money, you're at least able to speak intelligently about the basis of what they're using to value, so you can say, hey, wait a minute, you guys didn't take into account the fact that I have all this reduced risk because I'm using this network of people to help me do my job, for example, you know, to run my business. So it's more in the sense of, again, owning the information, presenting it in the best light to the people that you're trying to partner with, so that you get the highest amount of money at the least cost for you. Does that make sense?
Yeah, absolutely. Absolutely.
You know, we've floated these terms. I mean, I'm sure everybody knows what VC is and angel is, but you know, there is people out there that have been, you know, working as an employee for many years, who are thinking about branching out on their own and taking the data. I've spoken to 3 people yesterday that have just left their companies and branching out on their own for the first time, and it's exciting times. But a lot of people have never even thought about, where am I going to get some cash to branch out or do this, or, you know, where's the next kind of paycheck coming from? If it's not coming from the employer, how am I going to get going in those first few months? Can we just talk a little bit about the different types of you know, financing that is available? There was somebody that asked on the event page the other day, I think it was a, like you call, you know, solopreneur, or he was a one-man band, and he was wanting to get some staff in place. You know, then obviously that leads to, you know, bigger offices, equipment, everything else. So can we, you know, obviously I would say, you know, a VC or an angel is not going to be the solution for him. And let's just go through the kind of different, you know, everything from family and friends to angel and VC. You know, where do they all kind of come in the mix?
Okay. So the way I look at it basically is there's really 3 ways that you can finance your business. You can bootstrap, okay, which means basically doing your best to milk a stone, if you will, to get as much money as you can without getting it from a bank or an equity investor. So that's bootstrapping. That's the first way, and I'll go into these in more detail after. The second is to borrow. Okay, borrowing, the big difference here is that you get a certain amount of money today, but then you start paying it back with interest almost immediately. Depends on the type of arrangement you have, but you almost always start paying back right away, and you don't control how much gets paid back most of the time. it's either a fixed amount per month or it's a fixed percentage of your sales in the case of a merchant cash advance. Okay, so what happens is you trade money today, a big pot of money today, for little bits of money that go out of your bank account every month for the next, say, 5 years. Okay, so that's borrowing. And then what I call betting, because frankly, venture capital and angel equity, it's a very high cost source of finance, and the truth is as much as they're betting, you're betting too. Okay, because basically what you're doing is you're getting married to your investor. Once you invite an equity investor into your company, they do become an owner of your company, which a lot of people don't understand. That doesn't just mean they give you the money and they ignore you. That means they're going to be breathing down your neck, looking over your shoulder and saying, are you sure you made the right decision there? Are you sure you don't want to rethink that? Can you explain to me why you missed your budget this month? So as much as it has its place, it's something you really want to understand before you go into it. Okay, so those are kind of the three realms of investing, if you will. Do you want to start at VCs and work our way down? Do you want to start at bootstrapping and go back up?
I think, bootstrapping up on the way up, I think that's kind of more our audience, but I think it's all very helpful, but yeah.
The last one you mentioned sounded horrible. I'd rather just take my chances with scratch-off lottery tickets, to be honest with you.
Well, and while I do have the utmost respect for professional investors, which are the guys that I'm calling, the bet category, it is a very high-risk proposition, and I think it's important for company owners to understand that, because I do think, Carlos and I talked about this earlier, you can also get yourself in trouble with some debt instruments. With borrowing can sometimes get you into trouble, but I think that a lot of times people see venture capital money as this benediction. If I get a venture capitalist to invest in me, well, I must be a success, right? And the problem is that anywhere between 5 and 8 of the companies that venture capitalists invest in go bust.
Yeah.
So it is not this miraculous thing that somehow you're going to succeed because you got VC money.
That's the Shark Tank effect, right?
Exactly. Right.
It's a good time to mention that most venture capitalists work on a basket of investments, which is they invest in 10 businesses. They expect 8 of them to make nothing and be a loss. One of them will make their money back. They'll break even, and one of them will be a success. Right. And that's what they're betting on.
And it's also important to mention that the venture capitalist process is a very long and arduous process for the business. It uses a ton of resources. It uses a lot of space in your brain, a lot of your time that could be spent on other stuff. And for those 10 companies that Ammon is talking about that actually got a first-round investment from venture capitalists, most venture capitalists see between 250 and 500 companies before they pick those 10.
Yeah, absolutely.
So
and this is the thing. Even as a very experienced venture capitalist, no matter how carefully you pick your 10, 8 of them are still going to go bust. So they are taking huge risks, and this is why they expect big returns. Do not think that your company is probably worth as much as you think it is. It probably isn't, especially not to an investment guy. And do understand they are going to want a significant return. They are taking huge risks, and that's where the money is.
Right. And I think, again, it's not about saying it's good money or bad money. Okay, I'm not trying to pass any kind of value judgment. It's a very, very lucrative business, and it's a great way to get money for the right kind of company. But you need to make sure as an owner that it's the right thing for you. But you don't want to get into a situation like that and then all of a sudden realize, I've got no options because now I'm married to this company. Nobody else is going to invest in me if they won't, and you're kind of a hostage of the situation. So you really need to take, in French we say, prendre le couteau par la manche, take the knife by the handle, right? You got to make sure you get the right end of the deal, otherwise it can really come back and bite you in the butt. So, sorry, enough of my soapbox about venture capital. We were going to actually talk about bootstrapping, right?
Yep.
Okay, so to me, bootstrapping can really come in one of 3 forms. Bootstrapping can either be that you're going to improve the operations of your business, which means you're going to increase your sales or you're going to reduce your expenses. It can mean that you do a better job managing your cash flow, which means that instead of, for example, paying all your bills on the first of the month before all your clients pay you, you talk to your creditors and you say, hey, I'll pay you guys on the 20th. You know, it could sometimes be that simple if your problem is simply a problem of timing. Okay? Again, just one of the options.
Yeah.
Or the last option is that there are some places where you can find, quote, and I'm putting quotes around this, free money. There are grants out there, and then, you know, there's friends and family. But just like we talked about with the VC and the angel money, you need to understand what you're getting into before you pursue that type of financing to make sure that it's the right fit for you.
My rule is everything has strings. It's just what types of strings. So
and are they ones?
You only go into family and friends if you. I mean, it depends on your family and friends, obviously. But you know, you just got to make sure that you realize that again what you're getting into, and that you've asked for that money, and you know, there's relationships there, and it can sometimes hurt those relationships.
Right, and I think that it's important. I think you're exactly right, Carlos. You know, this we talked about in the green room as well. Although we'd love it to be true as an entrepreneur, you can't get something for nothing. So if you're going to get money for your company and it comes from somebody else, there's got to be some kind of counterparty to the money that they're giving you. Generally speaking, even your Aunt Tilda is going to want to know something, whether it's that she wants you to write her a letter once a month and tell her what your business is doing, or she actually wants you to pay her interest. That may be, you know, a different question. But you need to understand that you don't get something for nothing.
While we're at the sort of bootstrapping end of the equation, I think this is a great time to bring in Jason T. Weiser's question, which is, what's the smallest small business that investors and banks will partner with? Is there an approximate line that can be drawn where below that it's not going to be worth their time?
Okay, well, I think it depends on, there's two different things in there. Obviously, there's investors, which to me means angels and or venture capitalists, and then there's banks. Okay, the lines are different, and new products are coming up all the time. Okay, so that's the other thing that, you know, keeps me interested too, is that there's always a new product, there's always someone with a new twist on financing. For venture capitalists, frankly, most of the professional guys are not going to look at something that's under, say, a $500,000 first round, and that's already really small for them. You do have some companies, 500 Startups from Dave McClure, I think, is looking at something as small as 100,000. But, you know, it's a very rare case, and 500 Startups is it's not really a venture capital firm, although it is, you know, it's more of a venture accelerator, kind of a combinator.
Stephanie, I'm sorry to interrupt you, but just to clarify, when you say first round, you mean that's how much money the business is trying to raise, right?
Exactly. That's how much money they'll put in at the beginning of their investment. Okay? Keep in mind that as entrepreneurs, we have a lot of strengths, optimism being one of them. Unfortunately, in finance, that's not always a good thing, because it generally means you underestimate relatively severely how much money you really need and how long things are going to take.
If you're looking at a company that's trying to raise $100,000 and you just figure maybe they're looking to give away 10% equity in their business, you're talking about $1 million a year business. You really kind of need to have, right? Am I off base here? I mean,
they need to be more.
It would have to be more than $1 million, though.
Yeah, they want to make their money back, Eric. They've got to make 5 times their money back to have been worth taking all those risks for.
Right. So to answer that question, I mean, you have to be a pretty sizable business to even consider VC capitalists. I mean, a multiple $1 million a year business, right? So on the flip side of that, let me just ask this really quickly before you guys move on. Stephanie, do you have any thoughts on sort of micro funding or micro crowdfunding, sort of like, you know, Kickstarter and all these like GoFundMe sort of sites? Do you have any thoughts on that?
I don't have a ton of experience with them, although I know several people who've had good success. They seem to work better for projects. They don't really work so well for investments, and there's 2 reasons. One is that actually technically, I haven't heard the latest SEC rulings, but right now I'm not sure that you can actually crowdfund equity legally in the U.S. That means that what you can do right now is you can actually raise money online, but you can't give someone a share in your company. Okay? They're working on it, and supposedly it's in the final stages of happening. But the way crowdfunding works right now is that what you give people in exchange for their money, you call it a donation. They give you a donation, and you give them, for example, an autographed copy of your book, or a first-run cut of your movie, or a T-shirt that says, "I supported Joe's Pizza Parlor." But you can't actually sell equity online right now which is one of the huge debates that's been going on for the last like 18 months. Because clearly that was one of the directions that crowdfunders wanted to go, is, hey, if I can get a project funded, why can't I get my equity funded? And the SEC stepped in and said, look, we have no way to control this. There's a process for this. We need to work through it.
It does seem very similar, doesn't it, though, in terms of the discussion you guys were just having about there are strings attached, there's always strings attached, and you're kind of beholden to these quote-unquote investors for delivering whatever it is you've promised them that you're going to do or build or make, right?
Right, and in that sense, the notion of investing and crowdfunding and investment is, you could say it's not new. You know, it's the same as patronage in ancient Greece. You know, where someone needed to find a patron so that they could continue living their lifestyle, and they agreed to do a statue of the guy who became their patron. Right? You know, it's kind of the same thing. You got to look out for where the money comes from and make sure you take care of those people, because without them, you can't move forward. You can't grow. I don't want to get too far off track with this, but I think there is a distinction to be made between venture capital, angels, and eventual crowdfunding, which is what you're talking about. Okay, because it's really 3 different levels. You know, if equity crowdfunding becomes a reality, which theoretically it's close to being done if it's not done already, that would really be the bottom level. You know, you could take donations or equity pieces for $500 if that's what you wanted to do. Now, it will be a nightmare for you to track that many people as owners, but if that's what you wanted to do, you could certainly do it. Okay? And in between, the 2 pieces in between are really the angel investors. Okay, so let's say that the venture capitalists are really these guys that are, you know, high dollar. You've got to have, you know, it doesn't have to be a WhatsApp, but it needs to be something that's going to make, you know, multi-million revenues in year 3, probably, is where you need to be for that to make sense for you. Say that's not your case, that if you make, you know, 500,000 in year 3, you're going to be really happy. You still might be a good candidate for an angel investor. And the big difference between venture capitalists and angel investors is that venture capitalists invest other people's money, so that they need to earn not only the return that they've promised